sometime or another they'll be able to see my video and we'll be in good shape to get started. Wow, gasoline, that's the futures, but that's funny. I was just seeing $5 this morning at the pumps. No, absolutely not. Just look, imagine the spread. It's almost 100% markup from retail. So that's crazy. We don't like that. So we have a strong dollar. So to some extent, you know, a tiny little sell-off on the market against the dollar moving up is excusable. I don't care about that. And oil couldn't hold 80, even though there's 6 million barrel draw. Apparently, these draws are such bullshit that you can't even sustain oil prices based on them anymore. I mean, everybody's finally caught on to the fact that this is total nonsense. Petroleum status report. Thank you, Google. See, Google is an example of an AI that does one thing. It figures out what you're asking it. That's all it does. Well, it figures out who you're asking. It figures out who you're asking it, and it takes every single bit of information it can from you, and then splurges it back as advertisements. So that's pretty much what Google does. All right. God bless them, though, right? They're such a lovely company. Blah-de-blah, blah-de-blah. Commercial petroleum inventories decreased by 6 million barrels. Gasoline went up a little teeny bit, and finished gasoline decreased. Blending, blah, blah, blah. Distillates increased by the same teeny amount as gasoline. All in all, it was a big draw. In the SPR, they added 1 million gallons to the SPR. So 1 million barrels of demand was from the SPR. We exported a massive 4.4 million barrels a day. And interesting. So we import less. Notice we import less and we export more. And the same nonsense here, about the same as we always produce, is 20 million barrels, but 4.4 million of them are not for U.S. consumption. We only really use 16 million barrels a day. And this says gas prices are here, but again, that's retail. Well, no, it says retail prices. So that's retail price of gasoline. It's supposed to be $4.50, $4.60, but I've been seeing fives. Those greedy little gas station people marking it up. See, 5 is the point at which people start doing other things besides taking the trip. You know, I remember when gasoline it was $1 and it went to $1.50. Like when I first started driving, it was like about 80 cents, 70 cents. And then it went over $1 and everybody was like, wow, $1. Then it went to $1.50. And that was when we started, like, we were carpooling, we were figuring out like who pays for gas all the time. Everybody, you know, we make our trips based on that. Oh, it's going to cost 20 bucks in gas to get there. You know, you had to like weigh it out whether it was worth it. Those were the days. Went to Orlando and back. It's only like 3.5, 4 hours. And I went to Orlando and back, and I think I must have spent $200 in gas just to go back and forth. It was actually cheaper if I would have taken a plane and gone to Orlando. It's so stupid. Anyway, so where are we? So we look at the market. I think today we should really be talking about portfolios and portfolio management and things like that, because, you know, we just went and did our review yesterday. There's plenty of stocks that can still be played. We don't really need this because I did it all yesterday. Now, you see the short-term portfolio is now up 3.5%. So it gained $7,000 since yesterday, or a bit more than 7,000 since yesterday. I'm sure the long-term portfolio lost money, though. Ooh, yeah, it lost half its gains. So the long-term portfolio lost 23,000 or whatever since yesterday. You know, but you don't, you know, that's not important, frankly. It's what's important is that the short-term portfolio is rising, the long-term portfolio is falling. They kind of balance each other out. You're not going to see that immediate bump in the short-term portfolio, but if it stays, if the NASDAQ stays lower, it starts gaining ground pretty quickly. And So, you know, it's hard to gauge your hedges unless you have like really big moves, like 1%, 2% moves, then you can get a better idea of how well balanced you are. And if you're not, you have to make a change. Oh, and I think we did, though. I'm pretty sure yesterday we did do some changes. Let's take a look. Let's see what I said, because I sure don't remember. I do remember changing something in the short-term portfolio. Let's go to PhilStockWorld and find out. Oh, it says sign in. That's not a good thing. I gotta sign in. Oh, accept. Username and password is not correct. Well, isn't that going to be a problem? Are you serious? Ew. Oh, come on. Oh. Uh-oh, we got problems. What on earth? I'm not a robot. Oh, frickin' A. What did they do to my password? Oh dear, we got a problem, people. Oh wait, what's this? That's the July portfolio review from last time. That's not going to do it. It doesn't count down. It just tells you wait 105 seconds. P. Shit. Something's wrong. What is going on now? Oh, it went back to my old password, I think. Let me see if that's right. Subscriptions, annual subscription. Yeah, it went back to my old password. Sorry, folks, that was weird. All right, so where are we? Right, so when we do the portfolio reviews, and we already did the money to our portfolio review elsewhere, we talked about that already, so I'm not going to get into it. And the $700 a month portfolio is still doing very well, and we're not re-reviewing that. We just reviewed it the other day. But for the portfolios we have when we review them, when we talk about something that's got the butterfly portfolio plays in not so much to make income on the play, although we expect to, but it's about setting up a spread and making money on the spread. So in other words, Apple here is, well, it says at the bottom, I need to do the math thing. So the Apple spread was net $33,750, and we sold 4 months for $5,600 right there. So all on the same time. The net of the spread, including the sale, was $33,750. We sold the September 180 calls. We're just under 180. It's pretty much on track to expire worthless. To say it's half the price it was. And this is what I talk about when I talk about the acceleration. It's going to lose the next $5. So it took 3 months to lose $5, to lose $4. It's going to take 1 more month to lose the other $4. So you get a big acceleration in the premium decay in that final month, because all the premium goes away. No matter what people bid and ask for it, it's all going to go away. So the point is, so that we had 30 months on these Decembers, we had 30 months to start with. We sold 4, leaving us with 26 months. So that means if this was a 4-month sale, we've got 6 of these sales ahead of us, right? And if we can get $5,000, that's what I said being conservative, it's really 6.5, and it's really $5,600. But 6 times 5 means we'll collect $30,000 more back. And that means we'll be effectively net free on the spread. We'll be at $3,750, but maybe, we'll probably do better on the sales. So if we can get the net of the spread down to $3,750, and it's an Apple 160-200 spread with 15 options, that means we can make $60,000 and more, because we're not even fully covered. But we can make $60,000 on the spread, and we've reduced the basis to nothing. So that's the way the butterfly portfolio works. Is the idea is like, okay, we work down the spread so they're free, but we take a pretty conservative spread. So all we needed to do is just sort of go into our target range. And of course, here's the other thing, because we're selling these, first of all, we have 5 open calls, right? 15 long, 10 short. These are the puts. So that's the net, that's that spread. Then we sell 7, which is 2 more than the open. And that's not going to really hurt us. And the September 180s can be rolled up to the January 200s, and then they can roll up to the 220s. But as soon as we have to roll them because we were wrong, that means we're at least 20 times 15. We're at least $30,000 in the money before there could possibly be any damage to the short calls that we sold. And we only really have 2 uncovered shorts. So there's no way we're going to be in trouble on the spread selling calls. So if we assume Apple is not going to drop to 120 or something silly like that, then we will be in a position to sell calls, and we are almost guaranteed that we're going to be able to eventually sell $30,000 worth of calls against Apple. And if we can sell $30,000 worth of calls against Apple, then this spread is effectively free. In fact, I mean, to the point where, honestly, why don't we, and this is what always ends up happening with Apple, because like I was going to say, but honestly, why don't we just freaking have 80 of those? Why don't we do it 180? The ratio could be 180 short instead of 15, and we'll collect X of them, blah, blah, blah. And yeah, there's no reason not to, really, other than margin, and other than I'm looking to diversify and not have all my eggs in one basket. But when you think of the logic of this trade, where we're taking a 160-200 spread, and we're going to pay for the whole spread will be paid off in 2 years. And then whatever the spread value is what we get. Even if the spread goes lower, we can always roll the calls out to the 2027s and start the cycle again. But meanwhile, we'll probably recoup some of the money. It won't be zero. So we'll recoup some of the money, and we'll start again. It'll be even cheaper next time. The math will be even more in our favor. But losing, I mean, Apple would have to have a catastrophic loss for us to really lose, or it would have to get suddenly gain 30-40% for us to be in trouble with our 2 extra shorts. We only have 2 extra shorts. So it's not that likely that we're going to be in trouble no matter what this spread does. And as long as you want to be a long-term holder of Apple, then all this is great. I mean, look, our puts are the 160s. We're at 180 now. And still the net of this spread is what? Well, 72 minus 27, that would be 5. So that's 65 minus 2 is 45 minus, let's call that 10. So about 35. So the net of the spread is still 35,000. It's still a perfectly valid way to go. And I explain all this right here. So it's like, you know, yeah, it's like, it's nothing special about it. You got to read these things and say, hey, I could do that trade. That trade makes sense for me. But we don't want to be all Apple because you never know what happens. Look what happened here. It went from 140 to 200. I wasn't expecting that. We weren't in it then. We came in May when it was at 170 and we played the 160, 200. We did expect it to go to 200 eventually, just not in a couple of months. And now it's settling down and it'll start climbing again. But, you know, we expect to be here in 2025, not now. And then BHP's been pulling back, but that's fine with us because we sold the BHP. What do we even sell? The 60s. We sold the 60s. So we expected it to be below 60 and it's now below 60. When did we buy it? August 3rd. So on August 3rd, BHP was around here, somewhere in the 60, 62 range. And I said, well, 60 seems to be the right price to me. So we sold the 60 puts and the 60 calls. And as long as we're anywhere near that, we sold the puts for $2 and the calls for $5. So anything within $5 of 60 is going to be a winner for us one way or the other. And what do? We roll the loser. So I was agnostic about where it would be. I said, see, I picked 60 for a target. I said, you know, up and down from 60, somewhere around there. So we picked the 60 calls, 60 puts. We got $5 back on the spread, and we're going to roll. Only one of these can win. One's going to lose and one's going to win. They could both lose. It could be at 60 and they both lose. So, but in either direction, one's going to lose and one's going to win. And all we have to do is roll the loser. The one we lose money on, we roll it, and then we sell another opposite call or put against it, and we get more premium. And eventually, you only have to be right once, you know, because we're going to keep rolling and widening the spread and widening the spread, and eventually it lands in between the two numbers. And what happens? Then we collect on both sides, and we're done, and we start a new cycle. So it could be that it keeps going down and we do that, and then that means we'll have to eventually roll the BHP into a better position. Or if it goes up, we're fine because we picked a long spread. So flat is fine. That's what's great about the butterfly portfolio. Flat, we make money. Up, we make money. Down slightly, we make money. Only down severely do we lose money. Everything else, we make money. It's like a little money printing machine. International paper, we are waiting for it to get higher, even though it's already, you know, pretty up in our range. But we just, you know, we don't see the reason to sell calls yet. Pfizer is Pfizer. It's going to be 30. It'll be between 30 and 40 forever. I think we have examples. We talk about Pfizer from like years ago, saying, oh, 30 to 40 is the usual range for Pfizer. That's just there. It's because they pay out a lot of dividends. You know, they probably pay about a third of their earnings in dividends. So if you're going to take a third of your earnings and pay it in dividends all the time, you're dampening the ability of your stock to go higher. Okay. And of course, Philip Morris, also another business that's pretty saturated in the market and is not likely to go anywhere. But here we did sell. We sold the puts and the calls. Now notice here, my target's more like 97.50, right? Because we sold the $100 calls and the 95 puts. So I'd like Philip Morris to be at 97.50. And where is it? It's at 95. So it's a little bit in the low end of my range. My range is here. Anything in this range, we win on both sides. So ideally 97.50. But look at where this range is historically. If you follow that through, it's a pretty good place to put a range. That's going back a year, you know, about a year and a half, no, it's almost 2 years. That's like going 2 years back. And does it go, and here's why we don't panic though. It's like, does it go out of the range? Sure, it went way out of the range here, went out of the range here, went out of the range here, went out of the range here, but it comes back anyway. So just roll it and let it happen. Not a complicated strategy. It's the most relaxing portfolio. We basically never touch. We make an addition, but we never like adjust the butterfly portfolio except at the review times, and the review times are arbitrary. I pretty much do it I start the reviews in the very least on the first Tuesday, or the first Tuesday of expiration with the first Tuesday, the only Tuesday of expiration week. But that's usually when we start doing the reviews. And so that's totally arbitrary. And I guess, you know, for you guys who are new and stuff, you got to realize like the point of that is to teach you the discipline not to panic. Don't feel obligated to trade. Just now, if something goes crazy against us or something very bad happens or a situation changes, sure, I'm going to make a trade. I'm not going to say, oh, no, that's not our rule. But I try to say, and you need to learn it's okay to go, don't panic. They went up 10%. They'll come back down 5%. You know, depends. If they went up 10% for some decent reason, maybe they'll stay up. Maybe we'll roll. But it's nothing to panic about. Everything gets fixed. Everything gets fixed to the point where the butterfly portfolio, we're surprised if it doesn't make 40% in a year. You know, and we have that video that's about how to consistently make 20 to 40% returns. Well, that's exactly how we do it, though. And the butterfly portfolio is all about being the house strategy. It's all about saying we take a position, which is like opening a casino, and we invite people to bet. By selling them puts and calls, we're inviting them to bet that they think they know where something's going to be. So in other words, this guy thinks that BHP is going to be above 100 in September, and this guy thinks BHP is going to be, I'm sorry, Philip Morris is going to be above 100 in September. This guy says it's going to be below 95 in September. Neither one of them have any freaking idea what they're talking about. I'll tell you that right now. That's interesting. I did this accidentally at the time. This is the 1st of September call. This is only 17 days they have to make it back to 100, so that ain't gonna happen. That was a mistake on my part. I had meant to sell, and I would have gotten more money for the other September call, the September 15th call. The put's correct though. But either way, we're happy with the money. We picked up what, like $2,000. And again, we picked up $2,000. We paid 13.4 minus 8.5. So let's call that 13 minus 8. We paid $5,000 and we sold $2,000. 40% of $5,000 was our first sale. And we only used 3 months to do that. So in this case, we have all of 2024 plus a few months left in this year. 5 months, so it's like 16 months basically left. Excuse me, tired. And so, you know, we're making 40% using 3 months out of almost 20 we had to sell at the time. And we still have plenty. We still have at least 5 more times that we can sell this. So 5 times 40% is 200%. So we're going to collect 200% of what we laid out. And we still have the 90-105 spread. So if it ends up over 105, we're going to make 10 times 15 is $15,000 plus the double that we make on selling the calls. So I mean, it's just so simple. It's not a complicated strategy. The problem is, though, people don't like it because when you start off, look how boring it is. It's minus 1350 plus 950 minus 50 plus 88 plus 3. You know, we're up maybe $500, $600. It doesn't look like a play that's going to return 300-400%. Doesn't look like it. That's because it's going to do it slowly and steadily over the course of the 2 years that we're in the spread for. So we're taking bets on both sides. We're letting two different people bet us that the stock's going to go in two different directions. We're taking both their bets. We're like a bookie, right? We're taking both of their bets, but we have a hedge because the hedge is it wasn't below 95 at the time and it wasn't above 100 at the time. So that's our spread. So we have a what do we sell, the 90? Yeah, we sold the 95s and the 100. So we have a $5 spread. That's like the point spread, right? Like a football game. We're saying, we have 5 points. There's a 5-point zone in which both of them lose. And we took money from both sides. And statistically, it's, this is what we look for. We look for stocks that aren't likely to move too much in a channel. That's why mostly in the butterfly portfolio, it's big stocks too, because we don't want to buy a stock. We don't want a stock that's going to get bought. Although US Steel has multiple bids now for US Steel. So, and you would think they wouldn't get bought. They're, I want to say they're at least 30 billion. Oh no! Oh, no wonder they're getting bought. I thought they were way bigger. They're 6.7 billion. Shows what I know. Anyway, okay, so no wonder they're getting bought because that's silly. Wow. And who's bidding for them? Cleveland Cliffs, who are a $8 billion company, bigger than US Steel. US Steel really fell apart, man. And because they used to be worth a lot more. And Mattel, though, now Mattel's a monster. I like Mattel a lot. And they're 22 billion. Wow, the whole steel industry is just shit, isn't it? What do they used to be? Yeah, look at this. That's why I have that stuck in my head, because look at where these guys used to be. And US Steel is the same thing. We're not banning steel. Yeah, US Steel was well, now it's back to where it was. That's not long term. Yeah, also US Steel was in the over 150 at one point. Now it's 30. That's sad. This is what I got locked in my head, mostly because we don't really play steel companies. I like Cleveland Cliffs. We've played them a few times. I like Mattel. We've played them a few times. We've played US Steel a few times too when it was really super low. I was like, well, it's worth more than that. And now obviously, but look at them. They got their PE ratio is 11. They're not nothing. They bring in $1 billion worth of revenue. No, they don't predict it next year for whatever reason. They don't have a lot of debt because they went bankrupt, so they got rid of all their debt. So it makes them attractive for these other guys. That's all. It'll be weird if Mattel buys them, though. I can't see a foreign corporation being able to buy US Steel. I can't see that going through. So probably Cleveland Cliffs. That's why the CEO of Cleveland Cliffs, when you see him being interviewed, he's like, "Oh yeah, we're going to get this. We're going to do this deal," and he's not worried about somebody else coming in because anybody else who'd be interested is going to be from outside the country, and that's going to cause all kinds of problems. Technically they should be able to if you're a foreign corporation, but realistically they will set up all sorts of roadblocks to make it ugly. So where were we? Reviewing. So it's not complicated. Okay, we buy a stock, we sell premium, we buy stock, we sell premium. We're not buying stock, we're buying an artificial position in the stock. But notice that we tend to be in the money. Here's an 8,500 spread. It's at 95. With Pfizer, it's a 35.45 spread, and it's at 36. International Paper, we did a 27.40, and it's at 34. BHP. And why is that? Let's talk about why that is. It's because we are selling more premium than we're buying. That's the key to this thing. So for BHP, we did the 55.70 spread, right? So that's a $15 spread, and we paid $6 for it, right? So our net is $61. All right, we paid, so what do we pay? It's $61, our net $61. We bought it, we didn't actually buy it for this price. All right, let's say we were doing it now. because I don't want to go back and like figure out where it was at the time. Well, I know. Okay, let's do that. I'm just trying to think of what's the easiest way to show it without confusing everybody. All right. So we bought 823. 823? 83, sorry. Knew that was wrong. So on 8.3, BHP was August, was 62 bucks, let's say, okay? So when the stock was 62, we paid net 61. We paid 10 minus 6 is 10 minus 4 is 6, plus 55 is 61. So we paid $61, no premium. We had a credit, in fact, a credit to our premium of $1. We paid net 61, the stock was at 62. Then what do? We sold the $60 calls for $2.15. And because I expected it to go down, so we sold the calls that were actually below the price of the stock at the time. And we sold the $60 puts, which were out of the money, but a lot of people were betting it was going to go lower. So those were $3. And these guys were right, it's going lower. So even though the stock was at like 62, you got less money for the calls than you got for the puts because of that. I wanted to sell the calls though, because I felt it was going to go lower too. I was pretty convinced it would. But we sold this, these guys paid all premium basically, and or half premium here. So let's say they paid $3 in premium. We had negative $1 in premium. So now we've got a $4 premium credit. Plus we sold these puts, and those were all premium, 100% premium. And that was another, I'm sorry, that not those puts. Where's the other puts? These puts, the 870, that was all premium. So that's another 4,000. So we sold 1,000, I'm going to call that 1,000, 2, 3, and 7. We sold $7,000 worth of premium against our $11,000 position, but our $11,000 position was $11,000 in the money. We sold $7,000 worth of premium, and the premium will absolutely expire worthless. It will always expire worthless. Just because when the option goes in the money, it still runs out of premium, and it becomes the actual price when it expires. The premium absolutely disappears. It never, ever, ever doesn't disappear. And that's the only absolutely sure thing in the market, is that all premium expires worthless. So we don't buy premium, we sell premium because it expires worthless. Why would we not sell it? So the only negative thing that can happen to us is if the price target is way off, and we have to pay out of pocket to compensate for the price targeting. That's the only problem. So we have to be intelligent. So we generally pick large cap stocks that are channel bound. All right. Now, Apple is a big channel, can go from all the way down to 130, but basically it's from 140. Basically, Apple from 140 to 170 is a channel. The fact that it's a mile above the channel now, different story, but it still has a pretty predictable channel over the long term. I mean, and predictable in the way that we sold the 180 calls, even though it was going over 180, and we said, well, it's going to come back. That's how predictable that channel is. BHP, comfortable channel. And you got to look at that. How much does it violate your channel? Now, international paper, like I said, we didn't sell calls against them. I think they're too low. I want to see if they get back to 45 or at least 40 before I start selling calls. Pfizer also, Pfizer at the low of a very, very large multi-year channel. Pfizer goes from basically from 35 or really down 30. 30 is a low for Pfizer, and 50 is generally the high. And this was just stupid, whatever this was. But 35 to 50 is a good range. Philip Morris, 85 to 100, 85 to 105, $20 range. But a $20 range means it's only moving 10% up and down from the middle. That's fine. We can deal with that. Now, in the income portfolio, we went into, oh, no, I didn't. Sorry. Thought I went into detail on that one. Okay, I didn't really go into the, I forgot, I didn't really go into the kind of details that tell you how much something's going to make, like we always do on the Money Talk portfolio. We talk about what something's going to make. So, you know, here in the income portfolio, you'll see a lot of different styles. And again, these are educational portfolios, so it's more important that we're trying to teach you how we make these plays, why we make these plays. You know, it's not so much about the stock itself, it's about making different kinds of plays that make money, so you can see how it works. That market doing? Yeah. All right. So here we did CIM, we just sold the puts, you know, and they're at 44% already. What does it mean when you just sell the puts? I'm taking CIM, it was at $5 pretty much at the time. We sell the $5 puts for $1.75. That's like a nutty price, but that's what they are. That's what they are, because they're pretty volatile. See, this is not even, well, that would be 5. It's about the $5 line. So here's 5, here's 8. 5 to 8's a long way, right? That's 60% up and down. So that's a pretty major channel. So now we're back at 560, and in fact, let's take a look at what puts are at 560. And there's also sentiment, you know, there's more people buying puts and calls, so there's more demand for the puts. So it's 585 now, and it only goes out to January. That's why it doesn't look very attractive now. So, and again, this is the premium expiring, right? So it's not far from where we bought it, but these things are down to $1 now from $1.75. But what are we doing? We're promising to buy. So at the time it was May, and now so it's basically halfway done, these short puts. So in May it was $1.75. Now it's like a little bit over $1 for this spread. And what are we saying? We're saying I promise I will buy. In this case, it's 2,500 shares of CIM for $5, but you're going to pay me $1.75 for my promise to buy them for $5. So my net is only $3.25. That's, again, we're going back to that's 60% or 40 or 50%, whatever. Oh wait, it can't be 60. Killing me. That's 2 out of 5, so it's 40%. Because yeah, it's more like 40% below the current price. That's my promise. There are lots and lots of stocks I'll promise to buy if they go 40% below the current price. But the problem is, again, its allocations are very important. You know, you want to always keep an allocation block in your head or on the portfolio that you take notes of. And generally, we want to cut it if a portfolio is more than $100,000, you generally want to have 20 allocation blocks. If it's below $100,000, 10, because you can't really work with, you know, working with $25,000 allocation blocks is silly. That's what's the point of having a $100,000 portfolio? You want to have $10,000 allocation blocks so you can actually, you know, have a little more flexibility on your buying and selling and doubling down and stuff like that. You get limited in that when you're below $100,000. So it's a question of how many blocks you're going to have. So the income portfolio, I believe, started with it was 150. It was a weird one. Yeah, it was $150,000. So pretty much we're looking at, like, you know, 20 allocation blocks here of $7,500 each. There's just over 100. So we kept it small. We keep all the positions fairly small, and we want to have more positions. You know, diversification is good. So in the end, what am I promising here? Our net is 325. So 325 times 25, $8,000. It's half an allocation block. So I'm promising to buy $8,000 worth of CIM. And I'm being given $4,000. It seems crazy, right? I'm being given $43.75 because I'm promising to spend $8,000 to buy CIM. My net, including the $43.75 I'm being given, my net would be the $81.25. So I'm putting aside a half an allocation block on this position, or even a full allocation block, so I'll certainly double down if it goes low. If it goes that low, I'm going to want a lot more. If it's below $3, unless there's something drastically wrong with the company, I just want more of them for that price because they pay a nice dividend. Where's Mr. Yahoo? Here you are. I don't know if they're still paying it. I think they are. Oh, 12%. Wait, what happened? I saw that just as it flashed away. Yeah, look at that. 12%. 13, almost 13%. Ex-dividend, June 29th. They just paid it. So they're paying a 12.8% dividend. Of course I want it if it goes cheaper, because if that's 12% if you're buying it for $5. If you're buying it for $3, it's more like 20%, right? Because the dividend was 72 cents. So if I'm buying it for if it's 72 divided by 325 is my net purchase, it's 22% dividend. So I'm selling the puts for $1.75. That is more money than the dividend payout over 2 years, right? Because the dividend would be 72 and 72. So effectively, if I was going to buy the stock for the dividends, then why not sell the puts instead? Because if I buy the stock for the dividend and it drops, I lose money. If I buy the puts to collect the same amount of money as the dividends would have been over the next 2 years, more even, actually collecting more, then my worst case scenario is I'm going to get the stock for $325 instead of $559. I have absolutely no reason to buy the stock. It makes no sense. Not when I can sell the puts for more than the dividends. And that's why, and that's why these things work, because it's obviously you got to pick good stocks. You can't pick crappy stocks because you're going to lose money just like anybody else who picks crappy stocks. But if you pick good fundamental stocks that just basically don't drop too much, you're going to make a fortune doing it like this. I don't have to lay out a lot of cash. It uses margin. If you have a portfolio margin account, these things are incredible. I don't play the portfolio margin on these things. I basically play ordinary margin two times your portfolio. I assume that because a lot of people don't have brokers that give you, the kind of margin that you get in America. Like Interactive Brokers gives you 5 times, and Thinkorswim will give you like 3-4 times margin. And plus portfolio margin is a whole nother animal because that sort of ways to balance your portfolio. So, when they say if the market goes down this much, then your hedges will go up this much, and they count that against your positions and increase your margin. And they also use the position margin of anything you've got hedged in the position. So there's a lot of calculations going on that make it really low. But you can also get in huge trouble when you start using that kind of margin. The leverage gets pretty intense, and you don't want to do that. So anyway, point being, I set aside a half an allocation block. We have $15,000 allocation blocks. This is $8,000. Worst case scenario, I got assigned $8,000 worth of CIM. But either way, I'm being given $4,300 just to open the position. And if I don't execute my purchase of $8,000, I just keep the $4,300. That's 50% back on $8,000. But in Thinkorswim, where's my here you go, CIM. Sell the $5 puts for $1 in this case. So if we did it right now and we sold them, and I say basically I'll sell 10 $5 puts. Well, let's do 25 just so we have the same numbers. So I sell 25 $5 puts. I sell them for $1. And watch what it's going to say. $800 buying power. Only it's not even a thing. I collect, in this case, $2,500. And don't forget, this is 3 months into the trade, so I'm collecting half as much money. But even now, collecting $2,500 for $800 in margin that I set aside. And this expires in January. This isn't even a long-term trade. So that's the other thing. We're going to go right back and do it again. Whoops. Where was it? Okay. So BurgerFi in this case, and again, BurgerFi is at $1.79. In this case, we were aggressive. We sold 250 calls, but we sold 250 calls for a quarter. We bought it for $1.65 at the time. So our net was 140. Our net was 140, and we get called away at 250 with a very, very nice profit, right? With a $1.10 profit, which is, I don't know, 80%, something like that. We didn't sell puts because we didn't sell puts. Because I said if it goes down, we'll sell puts. If it doesn't go down, well, we're not going to chase it, so we won't sell puts. But if it just goes straight up, we make so much money, we don't care. And again, I mean relatively so much money. But the point of the income portfolio is to show you different ways to make money. So this is a simple covered call, but the simple covered call is going to make what I say 110. 110 divided by 140, yes, 78%. And in this case, it was, we laid out $2,800. So we're gonna make like $2,300 back basically, which is still obviously gonna be 78 in the same 78%. But the point is, yeah, it's not a huge thing, but it uses no margin. It uses $2,800 in cash, and in 1 year, not even, oh no, I'm sorry, this is a short-term call. I didn't even realize that. This is only a January call, because I'm sure BurgerFi doesn't have very long options. So it's not just a one-time thing. This is going to be, we make that much money. We make that much money every few months. That's crazy. So yeah, before it went out to January, now they added a month. This is very exciting. So they added a month now. And we're not going to do it again if the price isn't good. It was good last time. We got 25 cents for the calls. That was worth doing. Now here you can sell these 250 calls, puts, sorry. These 250 puts, well, you have to get $1 for them because it's at 157. So that's not worth selling. That's another reason we didn't sell it. It wasn't worth selling. So when these expire, if we don't see a good price, if I can't get another quarter out of it, we're probably not going to do it again. But if we keep getting a quarter out of it, we're at 140 and we sell another quarter for, like, this was June to January. So for the next 6 months, if we get another quarter, we go from 140 to net 115. And then if we do it again in 6 months, we go from 115 to 90. This is a different strategy for making money. We just constantly lower and lower the basis until we have 2,000 free shares of BurgerFi. Still got our cash, but we also have 2,000 shares of BurgerFi. At that point, we can forget about it for 20 years and hope they turn into McDonald's. And if they do, we'll say, oh, look, $1 million. I forgot all about it. But so there's one way to make money and another way to make money. Here's another way to make money. We actually go for the interest on this one, for the interest of the dividend. So here we're going to buy 1,000 shares of Blackstone. I'm going to promise, we bought them for $20, basically, 20, 30. I promise to buy another 1,000 by selling the $20 puts, but I sold them for $365. So I'm really promising to buy another 1,000 for $16.35. All right, so if I bought it when it was 2030, so 2030 minus what did I say, 16 what? 1635 is 395 divided by 2030 is 20%, 19%. So I've got a 19% discount here. So I'm saying, yeah, I'll buy it for 2030, and if it goes 20% lower, if I can buy it for a 20% discount, I'll buy another 1,000 shares. At that point, I would own it for, what did we say it was, 1635? So 1635 plus 2030 divided by 2. I would have it for 1832. But then I go and sell these guys for 350. Now, it would be minus 175 because if I get assigned, it would be minus the 175, half of that because I didn't sell as many. Follow? So minus 175. Did I do that wrong? I did. So it's 2030 minus 350 is 1680. And then I would get assigned another batch at 1635 divided by 2. So the net would be 1657. So what I'm doing is I'm buying Blackstone. Instead of 2030, I'm paying 2030 minus 7, which is 13. Oh, that's almost 715. All right, so it's that minus 6. Sorry, 2030 minus 6. No, sorry, minus 7 is 1315. So I'm paying 1315. I've sold the 18 calls. So if I get called away, and this is in 2025, if I get called away, I'm going to make the difference between 13 and 18, which is $5. So I'm going to make 5/13, which is whatever the hell it is. 38%. So if I get called away, I make 38% plus the dividends. And in Blackstone, BXMT, again, 11% dividends. And they just paid out. So I get 11% dividends plus 20% a year. So this is a 30% a year play. And it's super conservative. If I get assigned, I'm assigned 2,000 shares at 1650, I think it was. So it's like $35,000, right? $33,000. So $33,000, my worst case scenario. Basically one allocation block, because my buying power is 2 times an allocation block. So one allocation block would be used up if it gets assigned to me and I end up owning it at $16. Now, if I own it for $16.50 and I can sell calls for $3.50, that means I'm immediately going to drop my net to 13 again anyway. So if it goes down, I'm going to basically be at net 13 because I'm going to sell more. Even though I don't sell more puts, I'm certainly going to sell more calls. So my real worst case scenario is dropping it to $13, and I'm going to have 2,000 shares at 13. Well, the worst case is they suddenly go bankrupt and I got nothing. And anything else, though, if it goes up, again, we're 18. If it's at 20, if it doesn't go down more than 10%, then this trade's a winner, and we make our 30%. I'm sorry, 40%. We make our 40% plus, of course, the dividends. So that's 40 plus 10 plus 10 is 60% over 2 years. There's nothing. It's not complicated. It's a little counterintuitive because you say, well, I bought it for 2030 and I'm going to sell the 18 calls. That doesn't sound like a good idea, but it is because you have to think of the context of the whole trade and how it works. I'm owning the stock. That's the key for me. And people say, oh, I'm going to get called away. Not really, because he paid 18 plus 350 is 21.50. He paid $1.20 in premium. So he paid $1.20 in premium. And my dividend payments are going to be a quarter of 248, is 60 cents. So he paid $1.20 in premium. The dividends are 60 cents. If somebody wants to call me away and cancel my $1.20 in premium, they sure can. I'll just buy the stock again and sell more premium to the next sucker. The premium is double the dividend. I have no fear of being called away. Being called away means it cancels the premium completely out of schedule. That's not a bad thing. That's a good thing. And that's why it doesn't actually happen. It's very rare that's going to happen. You have to always pay attention to how much premium. As long as it's like if there's a nickel's worth of premium, it's not likely to get called away because the person who'd be calling it away could have just bought the stock instead. If they want to take the premium, why pay an extra nickel? The premium's only 60 cents. You pay 10% of it in premium just to exercise calls. It's not a logical thing to do. So it doesn't really happen that often. And if it does, you don't care because you collected $1.20 of premium on that call. You want it to get called away or expire. You want it to either get called away or expire. If it gets called away, God bless the guy who did it. Because you turn right around and say, okay, what can I sell now? So I go back to BXMT. And maybe you let it get called away and say, oh, well, forget it, it's done. But we see if we like the new prices, BXMT. So it gets called away. So now you have to buy the stock back at 21. And these $20 calls are 240. We did the 18s. The 18s are still 360, 375, whatever. That's great. If it's 375, then it's 2175, then it's 75% premium. It's 75% premium. The premiums aren't as good as they were when we took it, but they're still pretty nice. It's fine. As long as you got cushion on the dividend, that's what's key when you're buying these things. So then the same concept with Pfizer, except we were a little more aggressive on the call away price because and again, it's not a blind thing. I'm saying logically, I think Pfizer's way too cheap. Therefore, I'm going to be more aggressive on my sales. We just did this one. It was 37.10, and now it's 36.06. It actually went down, but it's the same logic on this trade. So it's cheaper now than when we started. NASDAQ covered ETF, this QYLD. So what do? They sell calls against the NASDAQ. Because they sell calls against the NASDAQ consistently, QYLD. I think they sell like monthly calls too. They're like constantly selling calls. Look at that return, 19%, or the dividend yield is an 8.5% payout. So they're just constantly selling calls and they distribute the calls, but because they distribute their income, again, they don't perform like the NASDAQ because they're giving away all the profits on the covered calls and they're getting called out with the covered calls. But if they can make 20%, that's fine by me. And not only that though, but because of the way they do it, 5-year chart, because of the way they do it, it's actually a very slow climb for these guys when they get out. So they were on sale. They climbed up nicely. And I expect the NASDAQ to pull back a bit, but that's why we're taking this and selling calls against that. It's like getting double the money. So they're selling calls and we're selling calls against them. And again, we came in at $17.85. We sold the $16 calls and the $18 puts. Our net was, this is what, 185, 234, about $4. So our net's about $13.85. So anything over $13.85, we win and we keep the dividend. If we get called away, it's that same concept. We get called away at 16. We're only going to make a couple of bucks at 16, but we're going to get paid very nicely, a good 10+% dividend on this thing also. So keep in mind, there's different ways you can make money in how you can generate an income while trading. That's the key to this thing. Barclays was so cheap we didn't sell calls against it, but our setup was a 5-7 spread. It's over 7 now. And you see that's 628. So let's take a look at Barclays. Nope, that's not it. See, there is no reason to jump in. I wanted to wait. We like Barclays. When the crash happened, Barclays was one of the banks that I said we should be watching them. They're probably going to pull out of this. That doesn't mean we jumped in here. Now, in the old portfolios, and this, I understand the style changes and that kind of might bother some people, but you have to understand, in the old portfolios, we were up 100, 200, 300% in the portfolios because they've been running for 4 years. So in the old portfolios, I would have jumped right into this stuff because we had tons of cash and tons of profit, and we're playing with house money. There's no reason not to take a chance. So Barclays is on my list, but no, in the new portfolios, we want to make sure we have winners. So we gave it a lot of time. And in June, I finally said, okay, you know what? This seems like it's a bottom. Now, notice that wasn't even the right timing. But all the way until June, it took us to decide that we would play Barclay at about $7 something, $8. Where are they? Oh yeah, here they are. So yeah, it was June 28th. It was right at the end of June. We decided to do that, and then then it dipped, and in fact, it dipped, and then we sold these $10 puts, so we doubled down or whatever we did with them. But the net for Barclays that we spent was 11.6 minus 11.4, $200. The net $200 spread. We spent $200 on what was effectively the 5-7 spread. So it's still in the money, even though Barclays dipped, because we were so conservative with the price. But this is 40 times $2, it's $8,000, and we only paid $200 for the spread. Now the $10 puts are aggressive, and we could be assigned $20,000 worth of Barclays at $10. But again, that's our aggressive play on Barclays. We felt that it has a very good chance of recovering. At the moment, so far, no. It's only at 750. But down the road, I think it'll recover. And if it doesn't, we're going to roll the put. That's another thing. These aren't as bad as you think, because first of all, we paid 10 minus 260 is 740. It's still over 740. So that's number one. These are still in the money. This is still over 740. Still a winner. The $10 put. Now let's say it was that's why you always have to think of like the next move and the next move and the next move. So the January $10 put is oh well, that's kind of crazy. It's got such a wide spread you can't even tell. All right, let's the $9 put. The $9 put is 160 for sure, right? 165, 155. So this is 160. Actually, you can figure it out because the delta is 95. So if this is 160, then that should be 160 plus 95, which is 255. So 255 would be about the correct price for these. So these are 255, and I can roll it to, oh, nope, the roll is terrible. It doesn't work. If these are 255 and these are basically 250 as well, that's not helping. So I have to wait for the premium to expire. But if it stays at 750, these would be 250, and these would hopefully be a better price. So I could either roll to the 10s of the next period, or we can double down and roll to 2 of the 7s. So it's not fixed. It's just a question of how much you have to adjust and how much you have to roll. And again, unless they go bankrupt, and then you're screwed. But that's true all the time. It doesn't really change if you do options or stock. BeyondTex also. The thing I like the most about BeyondTex, well, we talked about this one already in a different context. The thing I like the most about this is the super high premiums you get for the short calls. Crocs is the same kind of spread as BeyondTex, but we haven't sold the short calls yet. We're waiting for the stock to pop. Energy Transfer is my most, I love Energy Transfer. I just think it's a totally solid dividend stock. It's good for almost any kind of marketing conditions because it's a pipeline company. Energy Transfer. They move oil and natural gas from where it is to the terminals. So unless our entire oil industry shuts down, they've got pipelines. That's what pipelines do. And you saw how hard it was to get a new pipeline built, right? So they're running at capacity all the time. It's like it's a money machine. I love money machine businesses, just so you know that. Like Pfizer, people are going to keep getting sick. We need Pfizer. The population's aging. It's even a growth industry in Pfizer. Then we've got my beloved Intel, which is finally picking up a little steam. And this one got complicated. Basically, though, what do? short November calls. We picked up 2,700 on November calls. We adjusted this a couple of times, so it's real messy now. But the bottom line is, our main play is the December 30 calls, the 2025-30 calls. We have 10 short 40s of the same period. Okay. Then we have 15 short. Oh, those are puts. Sorry, with those puts. Then we have the November. I'm sorry. Then we have 10 short 45s. That's the most important thing. So 25 longs, the 10 40 shorts, and 10 45 shorts. So that's what we have, 25-20, and the average is 42.50 basically on the short side. So it's a 12.50 spread times 25 with 5 open. Then we sold 5 short calls, so 5 more than we actually have open, but it's obviously a very large thing. And you can do the math, and I'll show you how you got to do the math. I mean, I'm not saying you can't do the math. You should do the math, and you should do it so much that it's sort of intuitive for you. But basically, we paid, so we paid 18,975 minus 3,750 minus 9,750 minus, oh, we're already in the credit zone here, minus 2,700 minus, did I catch everybody? Yeah, minus 4,500. So we have a $1,700 credit on the spread so far. The spread is going to be 25 times 12, so it's 1,200 times 25. It's a $30,000 spread. So it's a $30,000 spread. We have a $1,700 credit, so plus 1,750. So that's our potential profit, is 31,750, but we're going to sell more short calls along the way. So you see how we sold 5 extra short calls. This 31,750 is what's protecting those 5 short calls. So how high would Pfizer have to go for 5 short calls to make $31,000? It's like $60 higher before we run into trouble. So it's not very likely that we're going to run into trouble on the extra 5 short calls. Therefore, I'd rather make the income and take that little risk that Pfizer pops higher than I thought it would. And again, rolling, rolling, rolling. If you're wrong, you're wrong. No big deal. And we haven't even sold short-term puts. So here's the thing. I don't like messy trades like this because it's confusing when I look at it. I can't quickly see what I'm doing. So I would probably, assuming Pfizer keeps going up a bit, I'm probably going to roll the $40 calls, which are currently $7. We'll roll them up $5 to the $45 calls, which are $5.50. Then we'll see 20 short 550s, and this trade will make a lot more sense, right? But notice that. What are we going to be doing? We'll spend $1.58 to roll the 40s to the 45s. So we'll get $5 more upside for $1.58. So if Pfizer hits 45, we're going to make $3.50 on the extra $1.50 we spent. That's the adjustment. Now, if it goes the other way, I could sell these and roll and sell something lower, and then take that money and roll to the 25s. There's so many ways to fix it that I stop worrying about it, you know? And that affects my allocation block decision too. So does this require a full allocation block? When I started, I had to put aside a full allocation block for the $30 puts. So we sold 15 $30 puts, 45,000 bucks. So my allocation blocks are 30 bucks. So my allocation blocks are 15,000 with the buying power of 30,000. So technically it's a full allocation block, and it is right now. But if we go over 40, I will probably think in my mind I'm going to release about half of that, because it becomes much less likely that we're going to need this allocation. If we don't get assigned, we don't need the allocation. We can move on and use it for something else. But you also have to be aware of that you've released an allocation. So it's something you can just put in the notes, basically. You should have, this portfolio, this thing of power options, it makes these charts. It also has copious notes, and you can put notes on the side and do all kinds of stuff. Yeah, I don't know what it costs. I think it probably costs like $100 a month or something like that, maybe less. Honestly, though, if you're trading a decent sized portfolio, like a couple $100,000 portfolio, and you don't want to spend $1,200 to make sure that you're keeping it in good order and have notes on everything and so on and so forth, that's penny wise, pound foolish. It really is. You got to be on top of stuff. You got to know what you're doing. You have to know what your plan is. You have to know what you're doing under each situation. So either you know it in your head or you should be taking notes. PhilStockWorld is like my notes. Anyway, so more of the same, more of the same. So now we're getting redundant because they're basically the same kind of trades. But you want to just keep an eye on the ones. When we make an adjustment, it's because it's good for a new trade. When we make these blue adjustments, it's good for a new trade. When I say it's good for a new trade, in fact, here, Control F, NEW. Wow, 19 times. New trade, 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 new trade. New York, doesn't count. News. New. New edition, new trade, new trade, new trade, new trade. So, 19, well, not 19, they all say new trades, but 12, whatever, in a month. There's 12 different trades that you could add to your portfolio right now. Very simple. So lots and lots of stuff to do. Now we're going to look at the beige book. So just so you have an idea of what we're doing, there are always opportunities. And of course, if you and of course you can always go back to the top trades. Let's not forget about that. I want to just do a commercial for top trades first. Top trades, very simple. And Money Talk is the one where we microscopically review things in the Money Talk portfolio. We say on every position, I say, how much are we going to make? How much is it going to come in? Whatever. I was going to look at the short-term portfolio. Yeah, in the short-term portfolio, we've gotten more aggressively long. Oh no, the point was I wanted to know what I said about it. I think I got more aggressive. Anyway, what is this? Oh, this is top trades, right? So in top trades, let's go through what we picked up lately. Here's Allstate and Prudential. You look and see how much it's changed. Pfizer, of course. These are the ones we already said. Qualcomm, definitely still good. See, even better than it was. Paramount, still totally available. WBA, cheaper, still available. This is good. Oof, wow. It's a lot of data. You know why? Because Yodi doesn't like him, so I have to basically prove why. I have to sit there and put an extra effort in to show why it is good. Ooh, Lennar got away. That's too late for that one because Warren Buffett started buying them. He said, Phil's buying it. I got to jump in there. Gold. Oh my God, that's crazy. Always got to take advantage of that. So, you don't have to wait for me to say now's a trade. It's like you can always go back and say, well, what's been a trade? What's still available? And I'm always happy in chat to talk about it. Say, is this still good? I'm like, yeah, still good. So where were we? Oh, yes, right. I was going to go back. And I was going to look in the short-term portfolio, STP. Very easy to navigate if you know your little shortcuts. And what did we say about SQQQ? We can still take advantage and roll 100 of the 70s to the January 30s at 140. Wait, what? 30s? Oh, I see what I did. Wow, really? Okay, so here's what happened. These, they were out more yesterday. No, they weren't. This is frozen. Okay, so these went up not these, 70s. The 70s are up 53%. Okay, they've gained half in 3 months. And we think the NASDAQ's going to pop back up. So I said, I didn't want to like take them all down because I'm comfortable leaving the 50 short forever and just letting them expire. I don't care because as far as I'm concerned, that's an unattainable goal. Because to get to 70 from 20, then SQQ has to go up 50, so it has to go up 250%. So 250% means the NASDAQ would have to drop like 70% for those to hit at this point. That's not at all likely. If it does, frankly, if the NASDAQ drops 70%, we have much bigger things to worry about than whether we have to pay off the short calls in the portfolio. I mean, the world would be falling apart, basically. It would be like 2008, just complete, utter disaster. Could happen, but obviously it could happen, but it's not very likely the NASDAQ's going to melt down to that extent. And even if it does, though, we still do have the open call. So, point being, I said, okay, well, I don't want to spend $37,000 to clear them all. So what we did is we took 100 of them, most of them. We took 100 and we changed them to a shorter term call, and the call was this January 30. So 30s are 50% higher than $20. So 50% divided by 3 is what? 17%? 18%? Wait. 21, no, 17%. So the NASDAQ would have to fall 17% just for those to go in the money. And I don't think that's very likely either over the next few months. If it does, it does. We'll deal with it. But because we still have the 200 longs, it's not a tragedy. We're moving 100 to January. We're taking from 250 to 140. So we're going to get 140, but it expires 2 years, not 2 years, it expires a full year before these short calls. And what does that mean? That means we get to sell 140 again and again and again. Instead of just collecting 250 once, we'll be able to collect 140 2-3 times. So we'll make more money doing that than we will leaving it alone. Therefore, we do it. And also, it means that if things look bad in January, now let's say the market does drop 20%, and the short January 30s that we're rolling to go in the money. Well, first of all, we're covered between 15 and 30. So that's fine by us. We didn't expect that's the other key to this. We didn't expect the SQQs to go past 30 anyway. That's a 20% drop basically in the NASDAQ. So we only were counting on this hedge to pay us off for a 20% drop in the NASDAQ. If it goes further than that, we go back to rolling. I can always roll the January calls back to the 2025s at a much higher strike, and that would give us a lot more headroom on those. I'm always happy to buy more longs. So if the market's in the middle of crashing, we'll make those decisions as they come. So I don't feel like I'm giving up my upside, and I also feel that I'm much more protecting my downside with the shorter term calls. Because not only have I sold those, but let's say the NASDAQ shoots back up and 1750 fails. Well, maybe then we'll sell the 25 calls as well. You have to just keep doing the math and keep understanding your position and keep seeing the coverage. So as it worked out, even after the change, we have $300,000 worth of upside protection in the short-term portfolio, downside protection. So that's what we look at. All right, so now, enough of that. You can do your reading you can do your homework on your own. How are the charts looking? Okay, beige book, not too encouraging. Let's see what it actually says. Beige book. The beige book. Oh, stop. Oh, supposed to just select HTML. Beige book, beige book. Okay. Let's do this. I tell you, I'm having a lot of trouble with Warren lately because they changed the thing. Where is he? No? Oh no, he's gone. What the hell? See, this one knows my password. Okay. Please summarize and analyze. Now you got to keep in mind that ChatGPT does not know that it isn't September of 2021. What is that? Delete. Oh, it's done. Bill. The economic snapshot provided in text suggests a mixed and somewhat cautious outlook for various sectors of the economy. Overall economic activity increased slightly since late May, with 5 districts reporting slight or modest growth, 5 nothing to change. 2 experienced slight and modest declines. Consumer spending was mixed, with growth observed in consumer services, while retailers noted shifts away from discretionary spending. Tourism and travel remained robust, and there's an expectation of a busy summer season in the hospitality sector. Auto sales exhibited moderate growth in most districts, while manufacturing activity edged up in half the districts and declined in the other half. However, transportation was down or flat, most reporting due to factors like high inventory levels and labor shortages. See, this is what happens. Labor shortages end up hurting the economy and slowing it down. That's when you reach your growth limit in the economy with labor shortages, which means either you're gonna factories have to shut down because they don't have enough people to run them, or you have to pay more money. Generally, they're going to choose to pay more money. There you go, back to your inflation cycle again. On the labor front, employment increased modestly, with labor remaining healthy. However, employees continue to face challenges finding workers in healthcare, transportation, hospitality. Wage growth moderated, and some districts reported stability or decreased wage pressures. Prices increased at a modest pace overall, with some reports slowing in the pace of the what? Wait, some reports of slowing in the pace of increase. That's an oddly constructed sentence. Consumer prices generally increased, so they were a variation of how firms are able to pass along cost increases. Input cost pressures remained elevated. That's bad for services firms, but eased notably in the manufacturing sector. Price expectations were generally stable or lower in the coming months. In the real estate sector, despite higher mortgage rates, demand for residential real estate remained steady, but sales were constrained by low inventories. Construction for residential and commercial was slightly lower. Agricultural conditions were mixed, but softened slightly on balance. That's good though, because we haven't had a lot of, that indicates that we haven't had a lot of crop damage, nothing significant worth mentioning. Energy activity decreased. Overall expectations for the months generally considered call for slow growth. Labor markets indicated modest growth with ongoing challenges in hiring, and the pricing environment remains relatively stable. While there are pockets of strength, cautious approach, some areas might warrant careful consideration in terms of business decisions. All right, good. So now let's see what they actually said. Economic activity. Now we got to watch for certain words. Economic activity. Second. Wait. Oh, that's the specific New York. Oh, it's a lot of words. Okay. Overall economic activity increased slightly in late May. 5 reported growth, 5 noted no change, 2 reported modest. Reports on consumer spending were mixed. Growth was generally observed in consumer services, but retailers noted shifts away from discretionary. See, that's bad, and Warren missed that. Shifts away from discretionary spending is bad. And it goes in line with my theory, and my theory is based on the fact that we have $5 trillion worth of consumer debt now, an all-time high. at an all-time high level of interest rate on that consumer debt. And frankly, that's why Joe Biden is so gung-ho to forgive these loans, because it's going to take us from, you know, it's going to get us off that 5 trillion mark. And it's a dangerous, dangerous level of debt. Okay, we are the largest economy in the world by a mile. No, by double, basically double China. So we are the largest economy in the world by far. The third largest economy in the world is Japan, or maybe India now, but either way, they're about the same. Japan's $5 trillion total economy. Our consumers are $5 trillion in debt. So just the consumers are an entire GDP of Japan in debt, which is the third largest economy in the world. These are not sustainable things. So yeah, of course, consumer discretionary spending is cutting back. Tourism and travel was robust. Look, it's the first vacation. I can relate to this. I talked to a lot of people about it. This is the first vacation people are getting since like 2019. So they're damn well going to take it no matter how expensive it is, no matter how hot it is. Auto sales unchanged, modest growth. Okay, so unchanged, modest growth is good, improvement. Manufacturing edged up in half and declined in the other half. That's weird. And as we know, we just talked about it the other day, Empire State Manufacturing Index is disgusting. And we get the Philly Fed tomorrow. We'll see if they're just as bad. And not far away. They're only like 90 miles away from each other. Transportation was down or flat in most districts. Warren basically just copied this whole paragraph. Banking conditions were subdued. Lending activity softening. That's not good. That's tightness of money. So stressed consumer, tightness of lending. Despite higher mortgage rates, demand for sales were constrained by construction, both residential and commercial, was lower. Agricultural conditions were mixed. Further softening of their. Agricultural conditions mixed, softened, slightly unbalanced. Some contacts softening for the remainder of the year. Energy activity decreased. Overall economic expectations for the coming months generally continue to call for slow growth. Labor. Employment increased modestly in the period of most districts with some job growth. Labor demand remained healthy. Contacts for the hiring was getting more targeted and selective. Employers continue to have difficulty finding workers. Healthcare, transportation, hospitality, high-skilled positions. However, many districts reported that labor availability had improved and some employers were having an easier time hiring than they were having previously. Employers also reported that unusually high turnover rate in recent years appears to be returning to normal. Wages continue to rise, but more moderately. Contacts have reported that wage increases returning to or near pre-pandemic level prices. Now, this is all fine, but that's because people think inflation is moderating, so they're not so inclined to push for more salary. If inflation comes back at the bottom, then people are going to need more money. Prices at a moderate pace overall. Several districts are slowing. Consumer prices generally increased, though reports differed. In the extent to which they're able to, so some people are getting pushed back on costs. Contacts with some districts noted. Get closer, I can't be that far away. Contacts in some districts noted reluctance to raise prices because consumers have grown more sensitive to prices. Yes, that's obvious. While others reported solid demand allowed them to maintain margins. Input cost pressures remained elevated for, it'd be nice to know who they're talking about here. Freight rates continue to decrease along with prices for many construction inputs. Concrete prices are up. Price expectations were generally stable. Highlights from the districts. Don't really need that. Blah, 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 blah. Oh, okay. Well, that's that. It's so short now. It used to be so much longer. So yeah, it's fine. It's actually not a bad report. It does indicate that inflation is moderating. There's still certainly wage pressure at the bottom. The question is, what happens after the summer? What happens when and if Biden does his loan relief? Where are we going to end up? Is people going to go out and party with that money, or are they going to pay down their debt? That's what we don't know for sure. and the market is taking it better. Okay, well, getting some positive spin on it. So the day should not be a total disaster. But data like this, it just tells you it gives you an idea of what's going to come down the pike, and it can set the direction for your betting. But if it's unclear, then you say, oh, well, it is what it is, right? So let me see if I can take this. Now watch, we're going to go to Bing. And I'm going to take advantage of the fact that Bing has more up-to-date data. Chat. Okay, so what did I say originally? Control V. All right. Okay, so here is today's beige book. Frick, what I do? Whoa, I touched something and now it's not working. My keyboard is not working. What key is it? What could I possibly hit? It just suddenly stopped. Shoot. Okay, how about if I turn you off? Turn you back on. The keyboard reboot? No. Oh, it's a limited thing. Shit. All right, so we take out these district highlights. That's what it is. I hit a limit of characters. See, I don't get that with ChatGPT. All right, here's today's beige book report. Please use that as a basis along with all other current information you have regarding the Fed and their rate decisions, and tell us what the Fed is likely to do next and why. And see how he does. Ooh, keep the rates unchanged in the next meeting. The report indicates overall economic activity increased since May. Mixed results. Some districts reported modest growth. Others noted no change. This suggests the economy is still recovering from the pandemic, but not even on an uncertain pace. The report also shows inflation pressures moderated as prices increased at a modest pace. Overall, the districts noted some slowing. Consumer prices generally increased, but some firms were reluctant to raise prices because of consumer sensitivity or solid demand. What? Wait. I don't like that. Is that what he said? We're reluctant to raise prices because of consumer sensitivity or solid demand. See, that seems illogical. Input cost pressures remained elevated for service firms, but eased for manufacturing. Freight rates decline. The report further reveals employment has increased modestly. Most districts experienced solid job growth. Labor remained healthy, blah, blah, blah. Wages continue to rise. Wage increases returning. These findings are consistent with other recent data that show a slowdown in economic growth and inflation in the second quarter of 2023. For example, the Bureau of Economic, this is good stuff. For example, the Bureau of Economic Analysis reported that real gross domestic product increased at an annual rate of 2.6% in the second quarter, down from 4.3% in the first quarter. The BLS reported that the consumer price index rose 0.5 from 0.9 in June. The unemployment rate is 5.4, down from 5.9. Given this economic backdrop, I think the Fed will adopt a wait and see approach and maintain the current target of the Fed funds rate at 4 to 5% in the next meeting. The Fed will likely want to see more evidence that the economy is on a solid, sustainable path to recovery and that inflation is transitory and well anchored around its 2% target before making any further adjustments. The Fed will also monitor the development of the COVID-19 pandemic. See, the problem with these AIs is they seriously, it just so happens that when they were trained, how much news was about COVID, right? It was like now when you read the news, it's all about AI. Like half the articles are about AI. Back then, half the articles were about COVID. So they've got much too much information about COVID, or too much concern, or too much of a percentage of their thought process is geared around COVID, and they overemphasize it a lot. Of course, this is my opinion, based on opinion. The Fed's decision will depend on a variety of factors and data that may change over time. The Fed will communicate its rationale, blah, 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 blah. I hope you found this analysis helpful. If you have any questions or comments, please feel free to share them with me. Okay, I got some surety. Okay, my thought is the Fed can't afford to keep rates under 5% because the bond market won't accept it, and already there is low participation. What? Oh, it's cap loss instead of tab at the auctions. A lot of the Fed's power comes from the impression that they set rates when in fact it's a lot more complicated than that, and they can't risk being exposed as weaker than most people think. Now let's see what we get back on this. Okay, I agree that the Fed's rate decisions are more complicated than simply setting a target range for the federal funds. The Fed also uses other tools, QE. They maxed out their QE too, and balance sheet management. That's $1 trillion. They maxed that out, influence broader financials. The Fed's actions not only affect short-term rates, but the long-term rates determined by the markets. However, I do not think that the Fed is at risk of being exposed as weaker than most people think. The Fed has a lot of credibility and influence in the bond market, and it's the largest buyer of older treasuries. And again, they're supposed to be winding that down. The Fed also communicates its policy intentions and outlook through various channels, statements, conferences, blah. The bond market participants pay close attention to these signals and respond accordingly. The bond market reaction to the Fed's rate decision depends on several factors, such as degrees of surprise, rationale behind the decision, and the accompanying guidance, the economic conditions. Sometimes the bond market reacts in the opposite way one would expect. For example, when the Fed raised rates in December 2015, history, the 10-year Treasury fell, and the bond market interpreted the move as a sign of confidence in the economy. Similarly, when the Fed cut in 2020, the 10-year rate, those are special circumstances. Therefore, I do not think that the Fed can't afford to keep rates under 5% because the bond market won't accept it, and already there is low participation in auctions. So he's regurgitating my thing. The Fed's rate decisions are based on the assessment of the economic outlook policy framework and not on the bond market's preferences or pressures. That's bullshit when you're borrowing. See, this is the problem. When you're borrowing $1.6 trillion to cover your and to add to your $33 trillion deficit, that's not true. It's all about the bond market. See, I can get into a huge argument about this. The Fed can collectively, independently, and when necessary, develop its mandate. The bond market may react positively or negatively depending on how they align with the expectations. They affect the law. I hope you enjoyed this discussion. No, I don't feel that you did a good job. But there you have it. Okay, there's two people's opinions on the subject. You know, on the one hand, you got China lowered their rates and Russia lowered their rates. That gives the Fed a buffer because effectively that's like the Fed raising rates. So if China and Russia both just lowered their rates, and they just did, then the Fed staying neutral is effectively a raise. That will then give Europe a chance to catch up because they're only at like 3.25. You know, we're at 5.75. I'm sorry, 4.75 to 5, and they're at 3.25. So they're quite a bit behind us, like more than a point behind us in raising rates. So we will see how that plays out. But on the whole, that was an okay beige book. It's, I mean, it's exactly the situation we thought we'd be in, but there's nothing great about it. And you can see how, you know, the reaction. I'm sure on TV they try to spin it positively, but the reality is there's no improvement. Nothing changed since last month. And it's still very iffy. It's a watch and wait kind of market. We have to step back. We have to see what happens. Let it play out. Don't try to overguess things. And don't see, this is a problem with investing houses, so on and so forth, is they listen to these machines, and these machines only know what they read in books. It's just like when you get the Harvard MBA, comes out of school, and he comes to work for your company, and he thinks he knows everything because he went to Harvard and he learned. They are the worst. I mean, they really are. Because he went to Harvard, and therefore his professor, who blah, 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 you know, he knows how this works, and this is how you make a widget, and blah, blah, blah. Meanwhile, I'm like, well, you know, what's a widget? And he's like, a widget, you know, whatever you're making, it's a widget. And it's like, no, it's not. You know, we're making, you know, we're making trains here. We're not making cars. We're making trains. We're not making toilet paper. We're making trains. It's not a widget. It matters. A widget is a thing you stamp out on an assembly line from your class examples, whereas a train has 4,000 parts that have to be machine tooled in 8 different countries, and it takes like 5 years just to get all the parts together to begin assembling the pieces to put the car together. I mean, it's ludicrous. They got no, and the teachers got no concept either. Not all of them. I mean, there's some really good guys at Harvard, but I mean, a lot of these guys have been teachers for 40 years. The guy's been a teacher for 40 years. He doesn't really know how things work anymore. He probably knew how they worked 40 years ago, but you know, you have to look at ChatGPT that way. It learned a lot of stuff in school, but it doesn't know what it doesn't know, and it doesn't have an actual working knowledge of the economy, of things like that. But the problem is, unfortunately, more and more kids are starting to rely on OpenAI for everything, not necessarily OpenAI, but on AI for all these things, and companies are starting to lay off people and put in more machines. Lay off more people, put in more machines. The machines don't always understand what people understand. Having all the facts doesn't make you smart. I'm sure you all know plenty of people like that, right? It doesn't give you the intuition. It doesn't give you instincts. So that's why Bing is sitting there telling me everything you would say in a textbook about the Fed. But that doesn't take into account the current situation. The Fed has a $1 trillion balance sheet. They should never have a $1 trillion balance sheet. It's insane. And basically that $1 trillion is $1 trillion of government debt that's hidden on the Fed's books. It's $1 trillion worth of bailout money
that hasn't been dealt with or recognized yet, because what the Fed does is, and they just did a bank bailout too. They just write a check and they say, hey, you've got $100 billion of bonds with a 2% coupon rate, and yet those bonds are now selling for 4%. So that means if you have 8 years left on the bonds, it's 8 times 2% less than the market value, 16%. So your bond is, your $100 billion worth of bonds are only worth $84 billion because the bonds pay 2% below the current rate. That's how it works. It's not hard. Everybody thinks the bonds are so mysterious. That's all it is. If you have a bond that says 2% and it's good for 8 more years, and yet the current bond sells for 4%, that means your bond is worth 2% times 8 years less than the current bond. So if you want to sell your bond, somebody's going to offer you 16% less than a person who has a brand new bond at 4%. That's it. Very, very simple. So the Fed instead says, no, you're not going to lose $16 billion on your bonds. You're not going to lose 16% on $100 billion worth of bonds. We're going to write you a check for $100 billion. Because what the Fed's doing is they're buying $100 billion worth of bonds for $100 billion. So for them, they create the cash out of thin air. They log it. They log it on their books as $100 billion worth of bonds. But because the Fed never has to sell them, they will redeem them for $100 billion, get their $100 billion back, and they'll still declare the interest of 2% to be a profit. But if the bank was forced to redeem them now, it would be a 16% loss for the bank. So the Fed's like, we don't ever have to redeem it. We'll give you your full value now. But if the Fed was a real buyer in an open market, they would never pay that money for the bonds. So what are you doing? You're effectively bailing out. Well, you're doing two things. You're creating $100 billion out of nothing, because the way the Fed works is they write a check first. They don't have any money. They just write a check. Then they take the asset and put the asset on their books to cover the cash that they just created. But that's bullshit, because they take the asset on at a fake value. So what effectively happens? The Fed creates $100 billion out of nowhere. They inject it into the banking system by taking the bonds off the guy's hands. The bank writes the $100 billion. The bank takes the $100 billion. They write, we have successfully sold our bonds for $100 billion. We now have $100 billion worth of more liquidity that we can lend money against at the new rates. See, so the Fed totally saved them. The reality is they've erased a $16 billion debt. They've completely erased a $16 billion loss and injected $100 billion of cash into the system of liquidity. That's what the Fed does with their programs. And in the grand scheme of things, you're devaluing the dollar. You're putting more dollars into circulation. And the only fortunate thing about it is there are so many dollars. There's so many dollars in circulation. Basically, dollar assets are somewhere in the neighborhood of like $60 trillion around the world. So it's kind of a drop in the bucket if the Fed does $20 billion here, $30 billion here, whatever. That's not bad. But now their balance sheet is $1 trillion. That's getting towards 2% of all the money in the world, of all the dollars in the world, is on the Fed's balance sheet now. That's significant. It's not nothing. So, you can't, you have a textbook that was written 20 years ago when the Fed had a balance sheet of not even $100 billion. And the deficit was not $1 trillion. It was, deficit 20 years ago, a couple of $100 billion, and people were freaking out about that, a couple $100 billion deficit. Now we have a $1.6 trillion deficit on our $33 trillion debt. So that means we'll be $34.6 trillion at the end of the year, which will be next June. This is crazy.
And it's not what ChatGPT learned in school. It's not what Bing learned in school. You have to keep up. And that's what's disappointing about Bing. I understand ChatGPT hasn't been told anything since 2021. Bing has access to the internet. It should be learning. It doesn't learn. I've tried this many, many times. It does not learn. He can get me information, but he cannot think about it. ChatGPT, Warren, that I use, he thinks that he can put thought into things and actually come up with conclusions that make sense. But he's hamstrung with the data. And unfortunately, OpenAI, even though they got $10 billion from Microsoft, they pretty much gave it all back, paying for the cloud service expenses of keeping the AI running. And now they're basically running out of money again. And it was only November that Microsoft gave them $10 billion. So the $20 a month isn't cutting it for ChatGPT. They're not getting enough money that way. I don't know what they're going to do, but they're going to have to do something to make money. And the problem is there's dozens of AIs out there now. It's like, you know, I use ChatGPT because I've been training it. So I'm not going to sit there and run over to another model now and start from scratch. And Bing is hopeless. And Bing's probably, you know, it's got to be one of the best as an alternative. Well, it's still based on ChatGPT. I'd like to start working with a completely different engine, but every time I try one, I'm like, oh, this sucks. Bard is garbage, complete garbage. There's a few others out there I want to try, but I mean, it just every time I try one, I'm like, oh my god. That's why I get terrified when they change ChatGPT. I don't want to lose what I have. But the problem is OpenAI is in trouble as a company, not making money, losing tons of money. So how are they going to do the Herculean effort of bringing it up to date? It's a very expensive, very long-term undertaking, and it's only going to add more data, and adding more data means more money for Amazon Web Services and Microsoft Azure and whoever else they're paying to store the thing. So and by the way, that's also a problem because look at all the companies that are now starting to rely on this stuff. And what if they fold? Like I've thought of many things I want to do with OpenAI, but I'm like, I can't count on this service being around. I don't know for sure that they're going to manage. You know, it's like if you had all your stuff on Alta Vista, or if you had everything on Netscape, you know, and use those searches. What was the other one? Opera. Remember, Opera was a search engine. You know, it's like if you had customized your company based on these search engines, and the search engine fails, the company dies. Then what? Now you got to start all from scratch, and then you got to say, I don't know, maybe this Google thing will be good. You know, it turns out Google was good, and it seems like it's not going to go away. But the AIs, you have no idea whether the money and the time and the effort you put into the AI projects are going to be worthwhile. And companies aren't even considering this. They're just doing it. They're just running forward as if it's going to be like, oh, well, here you go, ChatGPT. We're going to run everything on that from now on. We're going to replace 5,000 employees with ChatGPT. And then all of a sudden, ChatGPT closes, and you've got to hire 5,000 people tomorrow to replace it. So anyway, watching and waiting. I want to sit back and see how things play out at the moment. That's my mode. All right, so have a good week, everybody. It was fun, and we'll do it again next week. All right, take care, folks.